Today, we're pulling back the curtain on Altria Group. It's a titan of American industry, but it's defined by a fascinating paradox. It's a financial fortress built on a product that's, well, in terminal decline. So let's explore how this cash cow is trying to navigate a future that's under siege.
To really get Altria, you have to start with one brand, Marlboro. That 41.6% you're looking at, that's its share of the entire U.S. cigarette market as of 2024. This isn't just a product, it's the economic lifeblood of the whole company, and it's bigger than the next 8 brands combined.
All right, so here's how we're going to break this down. First, we'll look at the Marlboro money machine. Then, we'll decode the financial algorithm that makes it all work. After that, we'll examine the big gamble beyond smoking, the fortress under siege, and finally, we'll get to the investor's bottom line.
Okay, let's dive right into the core of the business. At its heart, Altria is a financial engine. It's specifically engineered to extract the maximum amount of cash from Marlboro's brand power, even as the industry around it is shrinking.
And this is the central conflict, right? The company's entire financial structure is designed to squeeze every last drop of profit from a product with a user base that's getting smaller every single year. Their success literally hinges on managing this decline with ruthless efficiency.
Now, just look at the sheer profitability we're talking about here. The entire company runs at an incredible 58% adjusted margin. That means more than half of every single dollar of revenue is profit. But look closer. The smokable product segment, which is mostly Marlboro, that's at 61.6%. Those are margins that are almost unheard of in the consumer goods world. So the big question is, how do they pull this off? Well, it all comes down to the core mechanic of their financial model, what you could call the tobacco algorithm. This is how they actually engineer profit growth, even as the number of cigarettes they sell falls off a cliff.
You see, the whole algorithm is built on one simple economic principle, price inelasticity. Because nicotine is addictive, consumers are just less sensitive to price hikes. So if Altria raises the price of a pack by, say, 10%, they might only see a 3 or 4% drop in demand. That's a net gain in revenue, and it's a lever they pull like clockwork, usually twice a year.
And this chart, wow, it shows that algorithm in action, but it's also under extreme stress. In the first half of 2025, they pushed through price hikes of 10.4%, but that barely managed to offset a staggering 10% decline in volume. That tiny gap between those two bars, that's their profit margin, and it's shrinking to a razor's edge.
So facing that reality, Altria has been forced to make a massive strategic pivot. The company is now gambling billions of dollars on a transition to alternative, smoke-free products just to secure its own long-term survival. And this creates a fundamental tension right inside their own portfolio. On one side, you've got the financial bedrock, the legacy products that are declining, but still incredibly profitable. And on the other, you have the recovery play, these high-risk, capital-intensive, smoke-free products that represent their only real shot at future growth.
So their smoke-free strategy really rests on 3 main pillars. First, you have on! Nicotine pouches. That's their main engine for organic growth right now. Second is Enjoy, their $2.75 billion bet on an FDA-authorized vape. And third is Plume, a joint venture for heated tobacco products.
But here's the thing. This big pivot isn't happening in a nice, quiet vacuum. Altria's business, both the old and the new, is basically a fortress under siege from all sides. Regulatory, competitive, and legal threats. And this slide, right here, shows what might be the single biggest threat to Altria's future. You see, their legal, FDA-authorized vapes aren't just competing with other legal products. No, they are drowning in a market where an estimated 60% of sales are from illegal, unregulated disposable vapes, most of them flooding in from China.
And hey, you don't have to take my word for it. The company's own CEO, Billy Gifford, has admitted just how serious this problem is. He's on the record saying that this flood of illicit products directly compromises their ability to hit their own smoke-free future goals.
You know, this isn't Altria's first disaster in the e-vapor space. Their history here is pretty much a timeline of capital destruction. After that disastrous $12.8 billion investment in Juul completely collapsed, they went out and spent another $2.75 billion on Enjoy, only to see it get hit with a crippling import ban in 2025.
So, this import ban is a huge deal. It comes from a patent dispute with Juul Labs, of all companies, and it has effectively frozen Altria's main e-vapor growth engine. It's a critical legal blow that has stalled the centerpiece of their whole smoke-free strategy. So, after all that, what's the bottom line? Where does this leave Altria? Let's try to distill all of this down into a clear, structured summary of where they stand and what their future looks like.
All right, here are the 5 key takeaways. Number 1, the core strength is still Marlboro's pricing power. It funds everything else. But number 2, that strength is facing a huge risk. Illicit competition and legal battles have stalled their big smoke-free pivot. Number 3, this leaves on nicotine pouches as their top growth driver. Really, it's their only source of real organic growth right now. Number 5, the biggest unknown is whether their plume venture can actually challenge the established leader, IQOS. And all of this leads back to number 2, the key dependency. Their entire strategy now relies on the FDA getting serious about enforcing the laws against all those illicit competitors.
Which leaves us with one final, defining question. For all of its financial might, can a company that was built on a 20th century habit really engineer its own survival in the 21st? The answer to that is going to define not just Altria's future, but the entire landscape of the U.S. nicotine industry.